Hi there, this is Robert Schein, Managing Director and Partner with Blanke Schein Wealth Management. Well, today I want to talk about three topics and some observations for us, for our clients, friends, and family out there. I appreciate all the great feedback. A lot of emails coming in saying that you guys are watching these, and these are a great way in the world that we're living in today for communication. So let's get right into it. So for our clients and for any investor out there, it's important to have a plan. All of our clients have a financial plan, and we have an investment philosophy that's customized to their financial plan. And we stick to the plan. I think that's the message here. As we've seen in the last 4 or 5 trading days, the market's been extremely volatile. That's something that I've discussed several times. We know that we're going to have extreme volatility going forward, and you want to stay invested. We have some cash on the sidelines, and we do expect some more volatility, some pullbacks from the next weeks and months to come, and we'll take advantage of that accordingly. But as I stated before, the volatility is there and it's here to stay, but we're going through some signs that I've pointed to of market stabilization. And I don't mean the equity market or the stock market. I actually specifically point to the credit markets. And today's Wall Street Journal reports just that. It's talking about that the credit markets regain footing as the Federal Reserve's implementation of all of their stimulus is starting to take hold in the fixed income markets. Specifically, we're watching the Treasury market. So that's a positive sign. I keep make reference to all the morning research that we read. Everyone on the investment committee for the Blanke Schein Wealth Management team gets a packet of information of outside, basically every source possible, from the sell side research, which are the Morgans, Merrills, UBS, Goldman Sachs street of information. So we have all of that information that we get first thing in the morning, 3 o'clock in the morning to 5 o'clock in the morning in our inbox. And we go through that as a team, as well as the not so known published, but they're independents that have some great research that we get, that we have exclusive content to. And it's been really helping us navigate our way through this. And so that's what I've been sharing with you guys, is sort of all aspects of Wall Street as we curate this information to give you guys real-time information and stay connected. But some of the stuff that I'm going through, like this is Jones Trading. It's 26 pages from this morning. And I'm telling you, it kind of feels like I didn't go to medical school, but like a good 60% of this is all about medical, research. One, I've been sharing all the information that we have. There's a lot of vaccines on the way in terms of testing. There's a lot of therapeutics on the way. And there's one of the morning research pieces talks about a better 50% chance that by fall we will have a vaccine. So that's a 50% betting chance. One of the ways that it's pointing to that could be the case is the most recent stimulus bill, the CARES Act, provision that was just passed, signed into law. It now has billions of dollars set aside for research, not only to make certain that they fast track, but also to have commercial grade stockpile of that, even for the fall. So again, everything's happening such a rapid pace, but science and technology and all of our medical professionals are doing such an amazing job, and it's really worldwide. So as they work worldwide, we're going to get hopefully on top of this, and sooner than later, a vaccine. But we now have the money set aside for it to actually combat that and create a stockpile, so that we don't get the bounce back effect that we've all read about. Maybe the news has even talked about in the Spanish flu in 1912, and that was the biggest challenge that they're seeing, is that the Spanish flu was a bounce back effect, and that really affected the economy. So as we discussed earlier in our earlier broadcast to you, the rate of change is declining, and that's important as we look to countries like Italy, who are about 12, 15 days ahead of us, medically speaking, as it relates to these cases, and the curve itself from new reported cases to even, obviously, the death and fatality rate increasing. But Spain and Italy and a few other countries are on the backside, meaning of the curve that we're learning so much about, which means that about, as an example, March 20th, both of those countries sort of reported a 15% day-over-day increase and a 20% day-over-day increase, respectively, Italy and Spain, as most recent as less than 20 days ago, if you will, March 20th. Now we're seeing the rate of change decline. So yesterday, Spain's last 3 days average was 4.3%, and Italy's was 3.4%. That's the backside of the curve that everyone's talking about. And even in our morning research, we're talking about the United States following the same curve, and the proxy is also New York's Governor Cuomo came out and said the same thing, so we could see some flattening. So that's a positive sign there. Do your job, stay home, and social distancing is actually working. So as we know that that's working, the social distancing, and we can see that there is another side of the curve, and that's what sort of the equity markets are pointing to right now, as they've been up 3 of the last 5 trading days, which is a positive sign, sort of a relief rally. There's still going to be a lot more volatility ahead. I think that's important to understand, that the volatility will continue, as that's normal in a bear market. So as the market goes up a lot, it's also has the ability to have some more bumpy roads ahead. And that's part of the bottoming process in the bear market. Again, this is going to be the quickest bear market I think we've ever seen. No one knows for sure. I don't. But all the characteristics and all of the things that we're seeing is at a quicker and faster pace. Now, a couple of concerns that you want to keep an eye on is, yes, we passed the stimulus. Checks are going to be in hands, hopefully, that sooner than later in the consumer. But then the small businesses, the SBA loans, I think while the money is then set aside, the question is now execution risk. Can those banks, the community banks, the big banks, can they actually process loans and actually get the money in the hands of the business owners so that they can retain the employees and maintain a hold on the economy here as we have a stopgap in the next couple of months or so. So I think that's the biggest key and concern. Market has a nice relief rally the last few days, but I think there's going to be a lot more road to haul going forward. So it's cautiously optimistic is the way I see it. So I think one of the aspects that we get from our research that we're reading is just to be cautiously optimistic. Yes, we've seen a relief rally in the equity markets over the last 3 or 4 trading days. That is a positive sign. Again, that's linked to one, markets sort of see 3 to 4 or 5 months down the road. Again, we don't know what corporate earnings are going to look like. In fact, I think most analysts have basically thrown out 2021 in terms of guidance for corporations. And as I said before, corporations are now pivoting from being guidance and revenue driven to maintaining a stronghold on their key employees and making certain that those employees are in place, healthy and safe, so that they can, when we reemerge out of this, be stronger than ever. So I think that's a key thing. So guidance has been withdrawn, but markets have sort of indicated that there is another side of this in the next 3 or 4 months as we get back to our lives. And what that looks like, who knows? But I think it might be better. Some of the indications that we're getting might be better than we think, but it's going to be different for sure.